A. Calculate fixed, variable, and mixed costs and understand behavior in short and long term. Variable costs change in total with activity levels but remain constant per unit. Fixed costs remain constant in total within the relevant range but decline per unit as output increases. Mixed costs contain both variable and fixed components and may be separated using methods such as high-low or regression analysis. Short-term versus long-term behavior differs. In the short run, many costs are fixed due to contractual or capacity constraints. Over the long term, all costs become variable as capacity and resources can be adjusted. Assumptions about relevant range are critical. If activity exceeds normal capacity, fixed costs may step up, altering cost estimates and affecting budgeting and decision-making accuracy. B. Identify cost objects and cost pools and assign costs appropriately. A cost object is anything for which cost measurement is desired. Examples include products, services, departments, projects, or customers. Accurate identification ensures relevant and meaningful cost information. Cost pools group similar costs for allocation purposes. Indirect costs are accumulated into pools before being assigned to cost objects using appropriate allocation bases. Proper cost assignment enhances decision-making. Allocating costs based on logical, cause and effect relationships improves pricing, profitability analysis, and performance evaluation, reducing distortion in financial and managerial reporting. C. Understand cost drivers and the causal relationship with costs. Cost drivers are factors that cause changes in cost levels. Examples include machine hours, labor hours, number of setups, or number of purchase orders. Identifying relevant drivers ensures more accurate cost allocation. A strong causal relationship improves measurement reliability. When cost drivers closely reflect resource consumption, assigned costs more accurately represent economic reality. Different types of drivers exist. Volume-based drivers relate to production quantity, while activity-based drivers reflect complexity or transaction frequency. Selecting appropriate drivers enhances budgeting, cost control, and operational efficiency. D. Understand methods for measuring costs and accumulating inventory. Cost accumulation methods track production costs. Job order costing accumulates costs by individual job or batch, while process costing aggregates costs by department or production stage. Work in process, WIP, and finished goods inventories require systematic tracking. Direct materials, direct labor, and manufacturing overhead are assigned to WIP before transfer to finished goods upon completion. Inventory valuation affects financial reporting and performance evaluation. Accurate accumulation ensures proper cost of goods sold calculation, inventory valuation, and profitability measurement in both manufacturing and service environments. E. Identify and apply actual, normal, and standard costing techniques. Actual costing uses actual costs for materials, labor, and overhead. While precise, it may delay reporting because overhead is known only after the period ends. Normal costing applies actual direct costs and estimated overhead. Predetermined overhead rates improve timeliness but may require adjustments for over or underapplied overhead. Standard costing uses predetermined costs for all inputs. It facilitates variance analysis and performance control but relies on accurate standards. Each method balances timeliness, accuracy, and control objectives depending on organizational needs. F. Understand variable, direct, costing and absorption, full costing and their benefits and limitations. Variable costing includes only variable manufacturing costs in product cost. Direct materials, direct labor, and variable overhead are inventoried, while fixed manufacturing overhead is expensed in the period incurred. This method highlights contribution margin and supports short-term decision-making. Absorption costing includes all manufacturing costs in inventory. Both variable and fixed manufacturing overhead are assigned to products. This approach is required for external financial reporting under GAAP/IFRS. Each method has advantages and limitations. Variable costing improves internal analysis and avoids income distortion from inventory changes. Absorption costing aligns with financial reporting standards but may incentivize overproduction to increase reported income.